Money market funds account for 8% of collective investment scheme industry assets, and together with income and multi-asset income funds, they make up 30% of total assets in the industry. So, fixed income assets and money market funds are important for most investors as part of a balanced portfolio. Joining me today to delve into more detail on money market funds is Fund Manager Duayne le Roux. So Duayne, to kick us off, maybe you can just provide a refresher on the role of money market funds in investor portfolios and what investors should be thinking of and expecting when investing in these funds.
Certainly I can. Thanks for having me, Audrey, and thanks to all the listeners for tuning in. If I can make it really simple for investors I'd say think of money market funds as alternatives to a bank deposit. Right. So they don't offer the same transactional capability, of course, but they do offer an added return for investors who are willing to forego marginal liquidity. So that's maybe how I'd phrase it or think about it. And in terms of who to use it or when to use it, for investors definitely that are sitting on short-term cash, that don't need immediate access, that are looking to or waiting to deploy funds, I think money market funds really come into their own. You have the option of earning an added return for the sake of foregoing the marginal liquidity, as I mentioned.
So in terms of portfolio construction and the instruments that you have access to for this kind of a portfolio, can you give us an idea as well as any restrictions or limitations that would apply?
Yes, okay. If I were to simplify it, money market funds, I'd say what money market funds do really well is they group investors' cash together, different investors, and they offer the ability for banks and companies who are looking to borrow those funds an opportunity to do so. Now, they don't get to do this for free. They have to offer an added return, and in order to do so, we as the intermediary, we structure it in a way that makes sense for both parties according to loan type, structure, as well as term. And this added return that the borrowers have to offer up in order to be able to access this funding, we then pass on to the end client or the investors within the fund. And then in terms of restrictions or kind of rules, the money market industry is well governed by a set of regulatory framework, I can say. And within that framework, it clearly defines what you can invest in, what you can't invest in, what the limits are, where the boundaries are. Say, for example, within the money market space, not being able to invest in instruments longer than a year or not being able to invest offshore are kind of examples within this regulatory space.
So in terms of money market funds being low risk, liquid offerings, what should investors bear in mind in terms of the returns on offer from these portfolios?
Thanks, Audrey. So we'll take it back to the previous question just to keep it really simple again. What's happening in a money market fund is investors' cash is being grouped together, and banks, companies that are looking to access or borrow money come to the market, and they are able to do it through the money market space. From the banks or the companies' perspective that are looking to borrow, they want to do this in bulk, and they want to do this over a set period of time or maybe in a certain structure or form, but they don't get to do this for free. They have to offer up an added return, and this added return is what gets passed on to the end investor through the money market fund. What is important when thinking about the returns and how they differ or change through time, because they do, is that they change with the interest rate cycle, of course, but they also change with the credit quality of the borrowers. Why this is important to mention is because you want to make sure that the credit quality of the borrowers you're getting rewarded for, right? Commensurate returns for the risk. And this is why selecting the right borrowers is so important. And why for the end client, selecting the right money market fund is important, because they're doing that selecting for you. At this point, I think I'll just mention, the PSG money market fund, it's been in existence 20 years. And over this time period, we've proven to be a safe pair of hands, but also done so in a way that we've been able to offer commensurate returns to investors through the cycle.
So Duayne, in terms of where a money market fund fits into a client's portfolio, when is it appropriate to hold a money market fund, And when should investors perhaps rather be considering, for example, an income fund as the next most risky step in the investment spectrum?
Great. Yeah, great question. For the money market fund, within a money market fund, I'll refer back to the beginning. Conceptually, whenever you're thinking of using a bank deposit, for example, this is where a money market fund could really come into its own. Again, foregoing a bit of liquidity because the transactional capability is not the same, but you're getting an added return. So if ever you've got short-term cash or you're waiting to deploy funds, money market funds really come into their own. Income funds, on the other hand, I'd say is, let's say, for example, you were considering a bank fixed deposit, right? You're considering tying your money in for a set amount of time. This is where an income fund could really come in handy. The returns are commensurate to that, but you still get similar levels of access as you would, for example, within the unit trust space, right? So you get that unit trust level of liquidity, but with the return set right up there with, for example, what a bank fixed deposit might be.
Duayne, thank you so much for joining me today and delving into money market funds and how they fit into a client portfolio.
Thanks, Audrey, for having me, and thanks everyone for listening in.